If you stand on a frozen lake in the dead of winter, you would swear absolutely nothing is happening.
Right. It just looks completely still.
Exactly. The surface is solid. You could stand there for hours, and just conclude that the whole environment is entirely dormant.
Mm-hmm.
But if you were to drill down just a few inches through that ice, you'd find these massive, chaotic currents just tearing through the water. Entire ecosystems shifting, colliding right beneath your feet.
I love that visual, honestly, because it perfectly captures the illusion we're dealing with in the financial markets right now.
Welcome to today's deep dive. We have a massive stack of sources today. I'm talking market newsletters, macroeconomic breakdowns from top analysts, and some truly historic statements from central bankers.
All from late April 2026, yeah.
Right. And our mission today is basically to decode a massive disconnect buried in these documents. Because on the surface, like that frozen lake, the crypto market looks completely stalled. Retail investors are bored. Prices are, barely moving.
Practically flatlining.
Yeah. But underneath that frozen surface, we're tracking tectonic shifts in global liquidity and, sovereign wealth.
And the contrast there is just genuinely jarring. I mean, you have retail trading metrics plummeting to levels we really haven't seen in quarters.
Mm-hmm.
But at the exact same time, the highest levels of global finance are, quietly rewriting their rule books to integrate these assets.
It's wild because everyone on social media is just obsessing over when Bitcoin is finally going to break and hold above the $80,000 mark.
Which is such a distraction.
Totally. Our sources reveal that the daily price chart is just a massive distraction right now because the real story involves this quiet new banking rule that might inject trillions of dollars in hidden liquidity into the market.
Yeah, and let's not forget a major central bank that literally just stood up on a global stage and declared Bitcoin the future.
Exactly. Looking purely at the daily ticker it's the fastest way to miss a complete structural overhaul of the financial system.
Because the noise of daily trading completely masks the architecture being built in the background.
So let's start by mapping out that frozen surface first, the current reality. Because according to the fresh earnings reports and newsletters we pulled, Bitcoin is just stuck. It's in this endless consolidation phase just below $80,000.
Right. And Ethereum and the broader altcoin market are just severely underwhelming expectations right now.
The hard numbers really paint a picture of a retail crowd that has simply, they've just walked away from the terminal.
They really have. The drop-off in trading activity is steep, and it's measurable across entirely different business models in this space.
Yeah, measurable and painful for the exchanges. I mean, looking at Robinhood's crypto revenue, it plunged 39% quarter over quarter, down to $134 million. And Hyperliquid wasn't spared either. They saw their revenue drop 31% down to $179.7 million.
Though, to be fair, the sources do highlight that Hyperliquid is sort of surviving this volume drought.
Right, because they're seeing really strong growth in real-world assets.
Exactly. Which makes total sense. I mean, when speculative trading dies down, protocols that tokenize physical yield-bearing assets like U.S. Treasuries or real estate, they offer a baseline yield.
Yeah, it keeps the capital from fleeing the platform entirely.
Right, but the sheer volume of crypto-native trading is just drying up.
Yeah.
Seeing revenue drops of 30 to 40% in a single quarter tells a very specific macroeconomic story.
It tells me everyone's bored. The newsletters actually project this feeling like a quiet, boring waiting room. Like everyone is just sitting there reading old magazines, practically falling asleep.
Yeah, the average retail investor just feels suffocated right now, because the Federal Reserve is holding rates steady today, and the broader context is that inflation remains stubbornly high.
Wow.
When you combine that sticky consumer pricing with, elevated oil prices, it acts as this giant wet blanket on speculative capital.
Though I will say the sources do note one pocket of the market getting a bit restless in the corner of that waiting room.
Let me guess. The meme coins.
Always the meme coins.
Yeah.
Yeah, Dogecoin is apparently forming a base right now and projecting a relief bounce heading into May. And historically, if Doge moves, it kind of drags the broader meme coin casino with it.
Well, sure. I mean, meme coins are highly reactive to sheer boredom, but the broader paralysis we're seeing across the blue chip assets is tied directly to the geopolitical environment.
Oh, absolutely.
We are locked in these extreme cycles of geopolitical escalation and de-escalation. The S&P 500 and Bitcoin are, they're fundamentally holding their ground. But that constant threat of a global conflict headline keeps retail investors completely sidelined.
Yeah, people just refuse to allocate fresh capital when tomorrow's news alert could upend the entire global supply chain.
Right.
So if the retail investor is paralyzed on the sidelines, we really have to look at what the macro analysts expect to happen next to break this stalemate. Which brings us to the currents moving underneath the ice.
Fun stuff.
Exactly. Our sources highlight two dramatically different, fundamentally opposed viewpoints from major market influencers on the immediate future of global liquidity.
What's fascinating is these two camps are looking at the exact same economic data, but arriving at entirely different conclusions about where the capital will flow.
Okay, let's unpack this, because on the bearish side, we have analyst Benjamin Cowen. And Cowen is warning that the market is just completely mispricing the Federal Reserve's timeline. The consensus expectation out there is that rate cuts are coming to save the day. But Cowen argues that those high energy prices and the sticky inflation we just talked about are going to force the Fed to delay those cuts significantly.
And a delayed cut changes the entire psychological dynamic of the market. It shifts the narrative from a proactive soft landing to a reactive panic.
Right. He warns we might be facing a repeat of a 2022-style downturn. His logic is that when the rate cuts finally do arrive, they're going to be too late.
Yeah.
They'll only happen as an emergency reaction to a market crash, rather than a proactive measure to prevent one. And historically, delayed rate cuts act as a massive headwind for Bitcoin and higher risk assets.
Because they start to weaken and signal stress long before the Fed actually pivots. So Cowen's view is essentially, brace for impact.
Yeah.
Because the Fed is stuck.
Yeah.
And his perspective relies heavily on how the Fed has historically operated regarding the labor market. If employment is only weakening gradually, they have zero incentive to rush a cut and risk reigniting inflation.
Right. They wait until something structurally breaks.
Exactly. And when things break in the economy, risk assets bleed.
But then we flip the page in our sources and we hit a completely counter narrative. Altcoin Daily, referencing the macroeconomic framework of Arthur Hayes, lays out this massive structural bull case.
Yeah, the shadow liquidity argument.
Right. They argue that everyone obsessing over the Federal Reserve is looking at the wrong institution. They point to this looming U.S. banking reform called the ESLR rule, and they claim this rule is going to quietly authorize commercial banks to invent trillions of dollars in new credit.
This divergence is so critical because it introduces a completely different mechanism for injecting liquidity into the system.
But wait, I have to ask. If Cowen says the Fed is stuck fighting inflation and we're facing a downturn, but Hayes says this new ESLR rule allows banks to take on more leverage and create trillions in new credit, who is driving the bus here? Are we crashing, or are we about to see a liquidity rocket?
It's a great question, and it's actually about synthesizing both realities. The Fed might indeed be paralyzed, exactly like Cowen says, but commercial banks might become the new engine for credit expansion, which is Hayes' view.
Okay, so how does that actually work under this ESLR rule?
So ESLR stands for the supplementary leverage ratio. It's essentially a regulatory limit that dictates how much capital a commercial bank has to hold against the assets on its balance sheet.
Okay, like a safety buffer.
Exactly. And the new proposal would exempt U.S. Treasuries from that calculation entirely.
Wait, really?
Yeah. If government bonds no longer count against a bank's leverage limits, these commercial banks suddenly have massive freed-up balance sheet capacity to absorb basically infinite amounts of government debt.
Oh, wow. Which turns the commercial banking sector into the new engine for credit expansion?
Precisely. The Fed might have its hands tied, refusing to print money directly. But if the ESLR rule passes, commercial banks step in and fund these massive government deficits without taking a regulatory hit.
It's shadow liquidity. The commercial sector starts funding the government, which injects capital back into the economy, sustaining this environment of negative real rates.
Right.
And just to put that in perspective for you listening, negative real rates basically mean your traditional savings account might be yielding, say, 4%, but actual inflation is running at 6%.
You're mathematically losing purchasing power while sitting in supposedly safe cash.
Exactly. And that is exactly the macroeconomic environment that forces capital out of banks and into hard-capped assets like Bitcoin.
Investors are literally forced to flee to assets that cannot be inflated away by the printing of new treasury bonds. And the conclusion from Arthur Hayes and Altcoin Daily is that because of this looming shadow liquidity, Bitcoin likely already bottomed around $60,000.
So we're at the beginning of a slow, steady, multi-year grind upward,
Fueled entirely by commercial bank leverage rather than direct central bank intervention, yeah.
which is wild. And if commercial banks are quietly maneuvering to pump liquidity into the system, that naturally brings us to the ultimate whales in the financial ocean, right? The governments and the central banks themselves.
Oh, this is where it gets historic.
Yeah, the statements we have from late April 2026 show a sovereign shift that is genuinely staggering. We have Paul Atkins, the first ever SEC chief to formally speak at a Bitcoin conference, declaring on stage that the government is open for business.
That tone shift from sovereign officials has definitely crossed a threshold. We're moving from cautious observation to active integration.
But the actual bombshell comes from Europe, specifically the Czech National Bank.
Governor Ailes Mikkel's address at the Bitcoin 2026 conference. I mean, that was unprecedented for a sitting central banker.
Unprecedented. He stepped right up to the microphone and stated unequivocally, this is the future.
Yeah.
And our sources point out that Prague has incredibly deep roots in this space. I mean, it's the home to the first ever mining pool. It's the birthplace of the hardware wallet. And Governor Mikkel revealed that the Czech National Bank isn't just studying the asset.
No, they're actively testing it.
Right. They launched a pilot portfolio in late 2025, proposing an allocation of up to 5% for their sovereign reserves.
A 5% allocation for a sovereign reserve is enormous. I mean, traditional conservative funds might debate a 10 basis point position. Moving to target 5% signals immense conviction in the underlying mathematical properties of the asset.
I was thinking about it like this, right? Imagine a central bank's reserve portfolio is a massive, giant pot of mild chili.
Okay, I'm with you.
It's safe, it's predictable, it's designed to feed millions without causing any issues. It consists mostly of government bonds and gold. Adding just a 1% Bitcoin allocation to that reserve is like dropping a single highly potent jalapeno into the pot.
Right.
It doesn't ruin the recipe. The chili is still overwhelmingly mild, but it definitively changes the flavor profile and it significantly spices up the returns of the whole dish.
That's a great analogy. What's fascinating here is the financial mechanism driving your jalapeno analogy is a concept called non-correlation.
Okay, unpack that.
The Czech National Bank isn't doing this to take wild speculative risks with national wealth. They're doing it to protect that wealth because Bitcoin doesn't move in sync with traditional government bonds.
Oh, I see.
Yeah. If global bond markets take a massive hit due to the inflation we discussed earlier, Bitcoin might surge, or it might just trade sideways.
Yeah.
Because its price action is disconnected from traditional debt instruments, adding that small allocation mathematically boosts the expected returns of the entire portfolio without actually increasing the overall risk profile.
So they get higher potential rewards without exposing the national treasury to more danger. It completely flips the traditional risk model.
It does. And our sources quote Stepan Uharic, the CFO of Trezor, who captures this paradigm shift perfectly. For the last decade, the debate in traditional finance was always, is Bitcoin safe enough for institutions to hold?
Right.
Now, the script is completely flipped. The question dominating these central bank meetings is, can we afford to ignore it?
Because the risk isn't holding the asset anymore. The risk is being the only sovereign nation that doesn't.
Exactly. Even Standard Chartered is now publicly viewing BTC as a modern-day alternative to gold.
And once you have that, the sovereign game theory kicks in. If one central bank adopts it and boosts their national returns, neighboring central banks are forced to look at their own underperforming reserves, face their citizens, and justify why they're falling behind.
It creates a massive domino effect. As soon as one sovereign entity validates the math, the career risk for other central bankers to allocate capital just vanishes.
But, if central banks are fundamentally rewriting how they view this asset at the sovereign level, the actual consumer experience on the ground is really struggling to keep up with that narrative.
Oh, for sure.
If you look at the real-world utility and regulation of crypto right now, it is completely fractured. We are seeing a complete regulatory whiplash depending on which border you cross.
The contrast between G7 nations right now is stark. It highlights a really deep division in how regulators view the technology's end-user access points.
Right. Our sources highlight Canada moving aggressively to ban crypto ATMs entirely. Authorities are citing them as major vectors for scams and money laundering, basically bowing to rising global regulatory pressure to crack down on decentralized cash ramps.
Yeah.
But then you fly across the globe to Japan, and the environment is the exact opposite. Bitbank in Japan is rolling out a crypto credit card that allows citizens to pay their everyday utility bills seamlessly in Bitcoin, and they earn cash back directly into their exchange accounts.
It's a totally different world.
Right. Here's where it gets really interesting. If you are listening to this right now, how do you make sense of this global whiplash? One G7 nation treats crypto like a criminal tool by banning ATMs, while another treats it like everyday fiat for groceries.
We really have to view this through the lens of market maturation. What you're seeing is the messy, uneven process of regulation squeezing out the old, vulnerable technologies to make way for institutional infrastructure.
Okay, so the ATMs are the old tech?
Exactly. Crypto ATMs are a relic of the industry's early days. They're physically clunky, they charge exorbitant, borderline predatory fees, and they offer very little consumer protection against social engineering scams.
I mean, they were necessary when there was no other way for a retail user to convert cash into crypto, but today they're just an unnecessary liability.
Precisely. Canada banning ATMs isn't necessarily an attack on the digital asset itself. It's a systemic removal of an outdated access point. Meanwhile, Japan's approach with Bitbank represents where the entire global infrastructure is heading.
Toward integration.
Right. A credit card inherently integrates compliant, regulated exchanges. It normalizes the asset for everyday transactions while keeping the activity within a monitored financial perimeter. The Wild West elements are being systematically paved over to build modern, compliant highways.
And while regulators are busy playing whack-a-mole with physical ATM machines, the actual tech frontier has already moved completely into the cloud. The new infrastructure isn't a physical kiosk anymore, it's autonomous code.
Yeah, and the final piece of our source material highlights how fast this automation is moving.
It's staggering. Look what is happening with Telegram. Their TON network is introducing autonomous AI agents directly into the chat interface. And these aren't just text bots that give you price updates.
No, these are much more advanced.
Right. These AI agents actually utilize a localized wallet architecture to cryptographically sign transactions. You give the AI parameters and it autonomously executes trades, it bridges assets across different blockchains, and it manages complex staking strategies to earn yield.
It's actively working in the market on your behalf. It is the ultimate democratization of algorithmic trading.
Which is wild.
It lowers the barrier to entry so drastically that anyone with a messaging app can deploy sophisticated financial strategies. But the real shift is how these autonomous systems manage value.
Which brings us to the tokenomics we're seeing emerge in the most speculative corners of the space. Because Pump.Fun, which is a platform famous for launching highly volatile meme coins, just executed a maneuver pulled straight from a Fortune 500 boardroom.
They aggressively burned 36% of their total token supply.
Yeah, roughly $370 million worth of tokens permanently destroyed to create a massive supply shock.
A token burn of that magnitude creates immediate scarcity, sure, but the follow-up strategy is what really signals a maturing market.
Because they didn't just burn the supply, they committed 50% of all future platform revenue to an ongoing buyback program.
Exactly.
This is traditional corporate finance applied to a meme coin platform. I mean, when a massive company like Apple wants to return value to its shareholders, they take their massive cash reserves and buy back their own stock, forcing the floor price higher. Pump.Fun is taking a platform built entirely on short-term hype and applying aggressive long-term value mechanics to force sustainable growth.
It proves that even the most speculative, chaotic sectors of the crypto economy are adopting highly sophisticated financial engineering. The entire space is putting on a suit and tie.
So what does this all mean for you? Because if you log into your brokerage account today, your portfolio might look totally boring. You'll see Bitcoin moving sideways, you'll read headlines about exchanges losing revenue, and the market will feel profoundly stuck. The surface of the lake is frozen solid. But beneath that ice, the foundation of the global financial system is being completely rewired, from hidden commercial bank liquidity to central banks officially adopting Bitcoin as a reserve asset.
The quiet periods in any market cycle are always when the most critical infrastructure is built and deployed.
Exactly.
And, it leaves us with a final thought to consider based on the sources we analyzed today. We just discussed Telegram creating AI agents to trade crypto autonomously, right?
Yeah.
And we just discussed central banks adding Bitcoin to their sovereign reserves. Well, if both of these trends continue, how long until an autonomous AI agent is the one actively managing a sovereign nation's crypto treasury? Think about that the next time the market feels boring.
Wow. Imagine a piece of code autonomously executing the financial defense strategy of a G7 nation. That is definitely something to mull over. Thank you for joining us on this deep dive today. Keep looking beneath the surface, question those obvious narratives, and we will catch you next time.